Insurance is a contractual agreement. In this contract, one party pays up front for the other party's promise to protect against a possible future loss. Like all contracts, insurance contracts are governed by general contract laws and principles. However, insurance contracts are also governed by fundamental principles that are unique to insurance. Let's look at those fundamental insurance principles. We'll start with fortuity, which means chance events. Insurance protects against only fortuitous or chance events. This means that insurance covers a loss only if some aspect of the loss is not just unknown, but is unknowable and left to chance at the time the insurance is purchased. Sometimes the purchaser doesn't know if a loss will ever occur. For instance, a homeowner doesn't know if her house will ever burn down. The risk of a future house fire would be a fortuitous, insurable event. Sometimes the purchaser knows that a loss is certain to occur, but some detail about the loss is unknowable, such as the loss's timing, scope, or severity. The unknowable, fortuitous detail makes the loss insurable. For example, it's certain that someone who purchases life insurance will die, but the timing of a particular individual's death is unknowable and fortuitous. Thus, the person's death is an insurable event. Insurance policies commonly contain provisions that require fortuity, such as ones excluding the losses the insured knew about when the policy was purchased. Further, fortuity is such a fundamental principle of insurance that many courts will also read an implied fortuity requirement into insurance policies. Another fundamental insurance issue is guarding against the moral hazard of one party to the insurance contract manipulating the contractual provisions for the party's own financial benefit. For instance, imagine a store had a $1 million liability policy. An injured shopper had a strong $3 million claim but offered to settle for the store's policy limits.